Since I have some current clients that are doing a 1031 exchange, I wanted to make sure more people know about this great tax strategy. So first and foremost, let me start with, I am not a tax expert. This is not tax advice, and you should always speak to a tax expert for anything tax related. A 1031 exchange gets its name from Section 1031 of the Internal Revenue Code. It's a tax break. A 1031 exchange is when you sell one investment property and you use the proceeds from that sale for a similar or a like kind investment property. And you can defer your capital gains taxes on that sale, meaning no or little tax consequences on that transaction. But there are very specific steps you must take to make sure you can take advantage of this tax break, however. You must use a qualified 1031 intermediary, and the proceeds from the initial sale must be held in escrow because you cannot touch the proceeds at all or you will be taxed. The properties you are exchanging must be considered like kind in the eyes of the IRS for the taxes to be deferred. Examples are an apartment building for an apartment building or a single family home for a single family home. So here's an example of a 1031 exchange. Let's say I own a duplex that's worth about $1 million, but I bought it for $400,000. Now I want to invest in a different area that pulls higher rents. So I find another duplex in that new area worth $1.5 million. I could sell my current duplex and invest the proceeds into the new duplex using my equity that I've gained, which in this case is about $600,000, and can defer the taxes on that exchange. And there's no limit on how frequently you can do 1031 exchanges. There are also two key timing rules that you must follow in a delayed exchange. First is the 45-day rule. Once a sale is final of the property you sold, you have 45 days to identify 3 properties as long as you close on one of them. This is the 3-property rule. You can actually identify more than 3 properties, and this is a little bit more complicated, but as long as their aggregate fair market value doesn't exceed 200% of the aggregate fair market value of the sold property, then this is the 200% rule. Then within 180 days of the sale of the first property, you must close on one of the properties you are exchanging. The 45-day rule and 180-day rule both start counting on the day of the sale of the first property. You can also do a reverse exchange where you purchase a property before selling the old one and still qualify for a 1031 exchange. The 45-day rule and the 180-day rule still apply. You must transfer the new property into an exchange accommodation title holder, identify a property for exchange within 45 days, and then complete the transaction within 180 days after the replacement property was purchased. If you have any proceeds left after doing an exchange, which is called boot, the 1031 intermediary will get it to you after the 180 days. This will be taxed as partial proceeds from the sale and generally taxed as capital gains. This tax-deferred strategy is used by many savvy investors to help build wealth. There really is nothing like real estate to build wealth. If you have any questions about getting started with investing in real estate, feel free to reach out to me. Here we have the advantage of living in one of the most desirable markets in America.